All right, we're going to get started today by looking at the S&P 500, and you can see that we are totally oversold, and the stochastics are down to 13, 14, and we've broken through every moving average, and every moving average is starting to go down. That's an indication that we're in a downtrend, and our uptrend, it's been up in effect since April, is effectively over right now. So what we have right now, I enlarged this area right here. We have a downward pattern where it's a zigzag. It looks like we're following this pattern where we're going to rally a little bit and then go down and up. So we're in this pattern right now, and almost every stock in the stock market's going to follow that. So, and it's all basically revolving around the war in Iran and the closure of the Strait of Hormuz. So let's look at let's look at some lines of support for the S&P 500. Okay, you can see that we're in a downtrend here with the S&P, and we hit some key levels of support where we're at right now. You can see that we were last at this area in October and middle of November. And whenever we bounced at those levels, this is called a support, and we're at that same level right now. Now we could hold here and bounce, but if we break through this level right here, there's a very good chance we're going to go down to this next level of support right here. And likewise, if we break through that, we have another level around um, around 580 on the S&P 500. All right, um, so this means we've lost our momentum. If you have momentum in your portfolio, such as some of the things that we're doing really good, um, like gold and silver and basically everything that's been in a bull market this year and last year, you have to watch because a lot of those trends are breaking right now and we're starting to go down. So let's look at some of our calendar for this week. Okay, so we had Micron earnings come out this past week, and we had NVIDIA's conference. So, and we also had triple witching. I mentioned last week that triple witching happens once every 3 months, and that is what the expiration of options. That whenever options expire, there's a lot of buying and selling to cover those positions, and that artificially makes the stock market go down or up a lot and be very volatile. So um, we had a lot going on this week. We had the Fed meet, and they decided not to raise interest rates, and um, it's looking like we might have to raise interest rates if the price of oil keeps going up because the price of oil has a lot to do with inflation. And we'll show you a little bit later how the price of oil is affecting the stock market now. So if we look at the front page of Yahoo Finance, we can see that it's overwhelmingly fixated on oil, what's going on in Iraq, because that has a huge effect on the worldwide economy and the profitability of every company in the stock market. Um, this is a really big deal closing the Strait of Hormuz because that affects um, a lot of the manufacturing around the world. There's a lot of helium and critical minerals that go through the Strait of Hormuz that if some of the countries like South Korea and Japan can't get some of their oil or helium for manufacturing chips, then there could be a major problem for a lot of big companies. So basically, as this war escalates, the stock market becomes more volatile and may go down. We have some major markets around the world going down because of the possibility of disruptions of companies based on the Strait of Hormuz. So this is becoming a big deal. And um, if we look at our notes, if we look at our notes a little bit later, we'll find out that a lot of pieces are coming together to um, a lot of uncertainty is in the market, and that could lead to some volatility. I marked the month of March as yellow because basically right now we're in a war and we have a major economic disruption. A lot of we're in a downtrend. We've broken all major moving averages, so we have a lot of pieces coming together for there to be a correction in the stock market. So we'll keep watching. Um, we'll keep also watching some of the babies that are thrown out with the bathwater and see if we can find any good stocks to buy for a long term. All right, let's look at the earnings for this week. The biggest earnings report this week was Micron. They came in with better than expected earnings, and their forward projections were much better than expected. But we mentioned last week that people were buying this stock into the print of the earnings. And that is a buy on the rumor, sell on the news. That's what happened. Um, so, so we're going to go a little bit over the Micron earnings estimate changes from last week to this week. And you can see that it's overwhelmingly better than we were last week. Um, okay, so there's not a whole lot of earnings the rest of this coming week. A lot of no-name companies, smaller companies that don't really move the market. So most of the big earnings reports are out already, and there's not a whole lot of reports remaining that would move the market. Okay, so S&P is down 2% from last week. It's around 5% down from the all-time highs. We're really losing a lot of momentum. You can see 32% of the S&P is above the 50-day moving average, only 43% above the 200-day moving average. So our formula is when most stocks are trending downwards, that signals market weakness. So we're losing momentum. We see a lot of the companies that were winners last year are becoming losers this year. A lot of the catalysts for markets to go down are happening now, such as tariffs. We have layoffs causing defaults in credit. We have private credit issue with banks lending to private companies, and this could be itself a major problem. And on top of all that, we have a war with Iran, and we might not be able to get out of it easily. The price of oil is skyrocketing, and the reason why that's important is if as the price of oil goes up, it makes um, inflation go up with it because it's a major input into everything that you buy in a store. So major oil producers are cutting production, leading to higher prices, and that could lead to global economic slowdown. Um, Also, with the Strait of Hormuz being shut, that's causing a lot of companies not to have resources for their manufacturing. And some of the biggest countries that are hit are like Japan, which are 100% importers of oil and natural gas. So we have a lot of major issues that are coming together at once that could cause the markets to go down. So you have to be ready for that. Um, okay, so right now, whenever the stock market is in a crisis like it is right now, the seasonality and stochastics basically, you can throw them out the window because everyone's basically fixated on one thing, the Strait of Hormuz, and how much oil is costing day to day. So we'll bypass this for now. In our stochastics, um, you can see that we are oversold, totally oversold. We have a S&P short range oscillator is at negative 6.61, and it was negative 7.87 last week. So that's traditionally been a great buying opportunity. And the average gain after it hits these oversold levels in the S&P 500 is about 2.5% a month out after we hit this level. So, so it's oversold signal. Anything below 5 indicates the market is heavily oversold, suggesting a potential rebound. So, let's see. So one thing is we went through all the moving averages, meaning we've lost momentum in the stock market, and it's looking like we're in a downtrend now. So now what we have to do is look at some of the more important things like the U.S. Treasury. I could probably guess that the U.S. Treasury has gone up a lot mm, in the past 20 days or so because of the price of oil. And the reason why the U.S. Treasury yield goes up with the price of oil is inflation is almost a one-to-one correlation to the U.S. Treasury, 10-year Treasury. We have, um, whenever the price of oil goes up, inflation goes up, and and so does the 10-year yield, because if inflation goes up, the Fed will have to raise rates to make inflation go down. And if the Fed has to raise rates, that means the 10-year goes up with that raising of rates. So that's really bad for the stock market because there's a inverse correlation between the 10-year yield and the stock market. So you can see that this inverse correlation is perfectly working in this chart here. So we have to keep our eye on this 10-year treasury yield. So if it keeps going up, the stock market's going to go down. Okay, let's look at the major variables in the stock market. The price of oil is up another 1% this week. With there being threats around the Strait of Hormuz being shut down and supply going down, the price goes up of oil. And oil um, makes the inflation rate go up. So it's interesting. This week, the dollar index went up 1%. So when the dollar index goes up, we expect the price of gold and all commodities to go down. However, um, it seems like there's a momentum trade in gold right now that's unwinding. When a lot of times, whenever you have a momentum trade and everyone piles into it, sometimes the air is let out of that and people sell out. And that's basically what I think is happening right now with gold. But it does continue to have a one to one, a good correlation to the dollar index. So this gold being down has something to do with the dollar index going up. Let me see. Um, we'll go over gold a little bit later. See the fear and greed index. Who could have guessed it? We're at extreme fear now. And according to Jim Cramer, whenever you have extreme fear in the oscillator down to -7 to -6, it's time to hold your nose and buy and don't sell. Right now, we have this situation where we don't know when the end of this uncertainty in the war is going to happen. So you can't assume tomorrow is going to be a day that the stock market bounces. 5% corrections are very common in the stock market. We've had 48 5% corrections um, since like 1960s. So it's a very common thing to have. Almost once a year, we have a 5% correction. So, so this is the time you start looking to buy. And I like to look for companies that have a lot of free cash flow, that don't have a lot of debt, and they're very profitable. The companies that will do bad in this environment are companies that are borrowing money, and especially with interest rates going up, and companies that have a lot of debt and are not growing. So let's look at the AAII Individual Investor Survey. You can see that most amateur investors are bearish now, and the inverse translation is it's time to start looking for something to buy. Um, the VIX index, we're at 26.78. That is a fear, um, a mark of fear. People are starting to get fearful that the stock market's going to go down. All right, in our emotional graph, we're right here. We're not at capitulation yet, but we're like right between fear and capitulation right now. Um, some of the issues leading to a crash, we have um, the debt issuances to fund AI. We have an overvalued market. We have the S&P right now is about 20% overvalued compared to history. Um, we have tariff threats and we have the war that's going on right now. Um, so the reason why we go over this emotional graph is whenever there's capitulation, you have to twist things around to, I'm going to start looking for things instead of I'm trying to get out of the market because Warren Buffett says whenever it's raining gold, you want to put out a bucket, not a thimble. Okay. So what we're going to do in this talk, we're going to find a couple stocks um, that are quality stocks that are going down a lot right now. Okay, let's look at the first to worst. This has turned out really good. Um, from the beginning of the year, we had this theory that interest rates were going down. Investors would be reaching for stability amid chaos. Investors preparing for a slowdown in the economy and possible recession and chaos. And people will gravitate towards utilities, healthcare, and consumer staples. And so what's happening this year, the worst performing sectors from last year, which are these sectors, are performing the best. And these that performed the best last year are not performing the worst. That's why it's important whenever you make a portfolio to diversify so that you have a little bit of every part of the market in your portfolio. So whenever the oil stocks go up, you'll take advantage of that with that part of your portfolio. Um, okay, so let's look at the PE valuations relative to history. You can see financials are the most um, undervalued stocks in the stock market right now. You can see they're trading at 29% percentile ranking versus history. That means they usually trade for three times what they're trading for now. For instance, they would normally trade at a PE of 15, but now they're trading at a PE of like 5, if you want to add those up. Um, So this financials are probably the best sector valuations to start dollar costing into now. Um, and then real estate probably is the second best. All right. So let's look at, so you can see the energy sector is doing the best this year. It's up 28%. Consumer staples, no, consumer staples are up 5%, industrials up 4%, utilities up 4%, and materials up 3%. Um, let's look at some of the stocks going up and down today. We know from we know that the from the 10-year yield, let's look at that again. The 10-year treasury yield has been going up. So our cheat sheet is yields of the 10-year going up. It's positive for companies that don't need to borrow money, such as the financial sector, banks, insurance companies, insurers, and energy materials. It's negative for small cap stocks because they need to borrow heavily. High yielding stocks because as the yield for the guaranteed investment of the treasuries go up, the demand for high yielding stocks and investments go down. Home builders will be really hurt because as interest rates go up, the cost of financing and mortgages go up, leading to a lack of demand for home builders. Um, any company that needs to borrow money is going to do bad in this environment. Let's see if that matches our expectations here today. Let's look at the sectors going up and down the most. Gold, the gold commodity is down a lot, like 14% this week. So that's why gold stocks are down a lot. Telecom, they have a high yield. As the yield for the 10-year goes up, the demand for telecom yield goes down. Banks, home builders, that makes sense. We just mentioned why home builders, this is all interest rate related. Real estate, and that's very similar to home builders in as the price of as the yield for the 10-year goes up, the demand for housing and real estate goes down. Materials, um, the value of the dollar is going up, so materials and commodities in general go down when the dollar goes up. And let's look at one the sectors that are doing the best so far today. The financial selects and State Street oil and gas. Okay. So let's look at some of the stocks going up and down the most today. Okay, we see a lot of oil companies in here. We see um, Occidental, they're an oil company. We have APA Corp, they're an oil company. Okay, so we have oil and some of these companies are companies that went down a lot and they're bouncing a little bit. This is Workday. They went down like 30, 50%. Now they're going up just a little bit. Um, okay, Micro Computer, they're down because their founder was found to be selling chips to China illegally. Vistra Energy, all of these companies are AI infrastructure. Vistra, they do power for data centers. Constellation Energy, AI data center, utility company. NRG, very similar. SanDisk is a momentum stock for the AI infrastructure. So we have Corning is a company that does AI infrastructure fiber. So, and Ciena is also a networking company that's gone up a lot recently. Comfort Systems is a company that does air conditioning for AI data centers. So that's the theme for stocks going down today. Um, a lot of times, whenever one stock goes down a lot of companies in the same industry goes down in sympathy. Okay, that was a good exercise. Let's look at Dan Now's picks from the beginning of the year. This Impinj, it is really tanking. It's down 50% from the beginning of the year. That was his worst pick. Nike is down 18%. Um, Nike is still at this point right now very overvalued. Um, it's like a warship trying to turn around, and it's going to take a while for this company to. It's like a turnaround story. It's going to take a while for this warship to turn around and go in the right direction. It seems. Boeing is up 13%. No, it's down 13%, and Apple is down 9%. So these picks this year really were not that great. Um, okay. So our plan right now is to rotate in the conservative stocks from high tech stocks um, because we're in a different kind of environment right now. We're in a risk off environment. We're trying to look for companies with high free cash flow and low debt, buy small amounts of quality companies as they sell off, and look for stocks selling at a low peg ratio and it's safe from disruption, and rotate into undervalued sectors relative to history. Okay, that we'll keep that in mind as we go here. Whenever the war first happened, we made this chart, and it's very interesting what happened. We mentioned that the price of oil goes up, that stokes inflation. Consumers will have less to spend on goods that are increasing in price. So, with the Strait of Hormuz closed, there's uncertainty around the world. And right now, we can see stock markets around the world going down 5% at a time. And um, we might be on the beginnings of a world war, it seems. And that is a huge negative for the stock market. Um, Ramifications for being in a war. Will the war keep people keep buying American goods around the world? Will this affects the businesses we're studying? Um, right now, I assumed that a risk off would be gold and silver. Whenever there's global uncertainty, people usually start buying silver and gold, which have been a something that's stable in the worst of times. But now we're seeing gold and silver being sold off, which is not like other sell-offs and we've had before. Maybe that's because gold and silver have had such a big run this year. Energy definitely has gone up a lot. Consumer staples. I thought this would benefit from a crazy environment, but it's actually subpar right now. Utilities are definitely doing good. Healthcare, it is kind of going sideways. But definitely risk on investments have been going down, such as communication services and IT and financials. Um, all right, so let's look at some interesting charts. We went over, um, this is the XLE. You can see that as the Iran situation intensifies, the XLE, which is the energy select sector, has been going up around 30%. So we are definitely, this is one of the few markets in the S&P 500 that is going up. You looked at this stock last year. It's waste management. You can see that it's in an uptrend, It's American company. It's has nothing to do it has nothing to do with um, a foreign markets. It is affected by the price of oil, but they have contracts where as the price of oil goes up, they can raise their prices. So it seems like they're kind of insulated from what's going on in geopolitically. They're oversold and they're at the bottom end of their trend line, and it's basically an uptrend right now. You can see that um, okay, you can see that it's above all of its moving averages, um, and it's a conservative stock that pays a dividend. So this is an example of a stock that will do well in a time of uncertainty. Let's look at some of our this is the stock screen for this week. You can see that Micron is now a peg ratio of 0.125, which is just pretty low. We'll look at Micron's estimates, see how they changed since the earnings report. Okay, you can see that Bank of America, a lot of the banks are really selling at a discount because of this private lending crisis they have right now. You see JP Morgan is showing up in our screens. American Express, Visa. You can see that financials are the most undervalued sector we're following compared to history, and it's being sold off a lot. You can see that a lot of stocks are selling around their peg ratio of 1, which is means they're fairly valued. Okay, so let's look at Micron's earnings projections this week compared to last week when we reviewed it. You can see that um, last week their earnings estimates for 2028 were $51 in a year. Now they're 76. That means they're growing. They were growing 192% from 2027 to 28. Now they're expected to grow double that, almost double that, which is 334 times from 27 to 28. So it's amazing. It's amazing that the stock went down a great deal after the earnings, even though they had blockbuster earnings and forward projections. So that just kind of it's the way the stock market works sometimes. Sometimes you buy in the rumor and sell on the news. And whenever the stock market is going down a lot, this is a momentum stock. It's been going up a lot. Let's look at the chart. You can see Micron has been in an uptrend from the beginning of the year. It's one of the more positive stocks in the stock market, and it's overbought right now. And it went down like 10% after the earnings announcement. But you can see that it ran up into the earnings. So, like I was saying last week, buy on the rumor. Everyone knew the earnings were going to be great. And then whenever they released the good earnings, you sell on the news. So, so anyway, right now they have amazing estimates. Their PE ratio is, let's see what their PE ratio is right now. The PE ratio is 7.6. That is like 1/3 of the S&P 500, and they're expected to grow 17% from this year to next year. Oh no, they're supposed to grow 12%. So even where they're at right now, they're half priced from if you're valuing how they're going this year to next year. So we'll keep an eye on that. And whenever the stock market's selling off, even though a stock might be undervalued, that doesn't mean it can't go down more. So it could definitely I mean, in a bad market, good stocks go down with bad stocks. So it'll just get um, more and more inexpensive. You can see last week our estimates were 13 times undervalued. Now we're 43 times undervalued if these estimates are correct. So we'll just have to wait and see about this. And here's a story that came out in Morningstar. This might be the best core stock bargain in the stock market today. And the reason why I looked at this article, it's one of the stocks that I've owned since like 2000. I own Microsoft since 2010 or so. And it's been like a core part of my portfolio that I would basically never sell. And it's on sale right now. You can see that Morningstar says the fair value estimate is $600 a share, and that is like a 30% discount from where it's at right now. They said basically their wide economic moat arises from switching costs, the network effect, the cost advantage as a secondary moat sources. So they have an immense product breadth, its applications tightly integrated with one another. So it's really hard to switch from Microsoft. If you want to go from to another office, you got to train people how to use a different application. So switching costs are very difficult. Um, hold on. Okay. Okay, you can see that they have let's look at their moat rating. They have a wide economic moat. They have a fair value. They have 32% discount, and they said their fair value is $600 a share. So they downgraded a lot of companies based on AI concerns. They downgraded Adobe, Descartes, Manhattan Associates, Salesforce, ServiceNow, but Microsoft wasn't in that list because it's going to be really hard to replicate Microsoft Windows and everything that they have to offer. So let's look at what this is what CFRA said. They said a strong buy view is based on AI opportunities as Microsoft is writing investment with its complete AI stack from infrastructure development services like Azure AI, applications like Copilot. We see diverse ways Microsoft can monetize general AI, creating upside potential to our out years expectations. Microsoft will reap scale efficiencies through cloud adoption and higher gaming growth potential. Copilot is organized is as organizing layer creates moats by integrating with third-party agents. Okay, so um, it's interesting. Microsoft, instead of being displaced by AI, they have one of the major AI platforms. So they're losing some of their business from AI, but they're gaining AI business too. So they have it a little bit both ways. According to CFRA, they're undervalued by 40% right now. And you can see one of my favorite tests for a good growth stock is that every year you see an increase in the cash flow and earnings. And Microsoft is definitely pretty awesome with that. And they're also very inventive and creative. So they're always, I mean, they invested in OpenAI before AI was a thing. So they have a big portion, they have a big part of OpenAI right now, which is going to go public. That's another little catalyst for Microsoft. Look at their stock right now. You can see it's in a super downtrend. Sorry. Um, but if you go out a couple years in the chart, you can see we're right where we were at the COVID lows. Is this the COVID lows? Let me see. Let's look at, yeah, let's go out a couple of years here. Okay, this right here was not the COVID low. This was um, the day when Trump announced the tariffs. And you can see that whenever you have support right there, a lot of times this is a good place for that stock to have support. And so we have that, it's called a double bottom. We have a couple of different tests of that area right there. So this is a good place for Microsoft to have some support. Um, we do this with the S&P 500 too. Here's another level of support right there. And of course, this is the COVID lows of 2000. Is this right here? No, this is the COVID lows right here. And Microsoft has gone up substantially since then. But you can see that we do have support from the Emancipation Day, well, not Emancipation Day, the day that Trump announced the tariffs. Let's go back to our talking points here. Okay. Here's another article from Morningstar, lessons we learned about navigating stock market volatility. The first thing is 5% corrections like we had this week are very common. We've had 48 since um, the last 50 years. So it happens like regularly around once a year or so. So the first thing we can see from these recent crashes, it's impossible to know how long the stock market recovery will take. If you don't panic and sell your stock holdings when the market crashes, you will be rewarded in the long run, usually. You can see all these major situations in the stock market, and we have a lost decade of a 2000. But in general, those selling times have led to higher prices in the years and months ahead. And here's some more ideas. The stock market recovery, um, market crashes always feel scary when they happen, but there's no way to know the moment when you're encountering a minor correction or looking down the barrel of the next Great Depression. Um, but since the path of recovery is so uncertain, the best way to prepare is by owning a well-diversified portfolio that fits your time horizon and risk tolerance. Investors who stayed invested in the stock market in the long run will reap rewards that may make the turmoil worthwhile. Okay, so that's a good way to end this talk. I hope you had um, a good time watching this and have a great next week of investing.